Hello and welcome to this webcast on IFRS 16. I'm Patrina Buchanan and I'm joined today by my colleague Catherine Dunkersley. So this is the sixth in a series of webcasts following publication of the new Leases standard, and today we'll be talking about the requirements relating to lease modifications for lessees in IFRS 16. Just to note before we start that, as always, the views presented in this webcast are those of myself and Catherine and don't necessarily represent the views of the board or the IFRS Foundation. So we'll start by briefly explaining the purpose of this session, because lease modifications wasn't a topic that was originally included in our webcast series. So Catherine, why have we decided to do a webcast on this topic, and what can listeners expect to get out of it?
Well, essentially, we've included this topic because we've heard some questions from those working on implementation of IFRS 16. On the face of it, modifications is a topic that only really becomes relevant after the new standard is adopted. However, companies, software providers and other organisations that are working on IFRS 16 are keen to get their systems ready for all potential lease modifications before IFRS 16 becomes effective. So whilst any questions coming up relating to modifications might seem relatively low on the priority list, organisations are keen to resolve these now. So in this webcast, listeners can expect to hear a summary of the modification requirements for lessees, and then we'll be discussing the implementation questions that we've heard so far. Modifications is something of a detailed topic, so we'll include examples as we talk it through. We'll also summarise key takeaway points from those examples at the end of the session. For the avoidance of doubt, everything we're talking about in today's webcast relates to lessee accounting. That's because all of the questions we've heard about modifications relate to lessees and not to lessors. It's probably also worth noting that this webcast assumes listeners are already familiar with the lessee measurement requirements in IFRS 16. If that's not the case, then it would be a good idea to listen to the measurement webcast before listening to this one.
So first, a summary of the requirements in IFRS 16 relating to lease modifications for lessees. As this slide shows, there are three different ways that a lessee might account for a modification. The accounting treatment depends firstly on whether the modification in substance represents a separate new lease. If it does, then the lessee accounts for that separate new lease as it would any other new lease. If the modification does not represent a separate new lease, then a lessee needs to assess whether the modification decreases the scope of the existing lease. The accounting treatment differs because if there is a decrease in scope, then a lessee will need to think about any gain or loss arising on the element of the existing lease that has been terminated. And we'll talk in a bit more detail about each of these scenarios in turn. So first, let's look at modifications that are accounted for as a separate new lease. IFRS 16 includes two criteria to account for a modification as a separate new lease, and both of them must be met. First, the lease modification must increase the scope of the lease by adding an additional right of use that wasn't there before. This could arise if, for example, a lease of property is modified to include an additional floor of a building. Second, the consideration for the lease must increase by an amount that is commensurate with the standalone price for the increase in scope and any appropriate adjustments to reflect the circumstances of the particular contract. So, for example, in a lease of property that is modified to include an additional floor, does the consideration for the modified lease increase by a similar amount to that which would have been agreed for a new standalone lease of the added floor, taking into account, for example, that the lessor might give some discount because he does not have to incur marketing costs to lease that floor to a new lessee? If consideration does increase by an amount commensurate with the standalone price, then the modification is in substance a new lease for that one floor. In that case, the lessee accounts for the modification exactly as it would a separate new lease of one floor of the building. When this accounting applies, there is then no special modification requirement because a lessee just applies the normal IFRS 16 requirements for a new lease. There is also no change to the accounting for the original lease. So let's move on then to the other lease modifications, those for which the modification does not represent a separate new lease, but instead is a change to the existing lease. There are two scenarios here, but in all cases, the lessee is required to calculate the lease liability for the modified lease. This is the lease liability that will be on the balance sheet after all modification accounting has been performed. The lessee determines this liability by applying a very similar approach to that used at commencement of a new lease. So the lessee does this by allocating contract consideration, determining the lease term, and discounting the revised lease payments at an appropriate discount rate. We talked about these areas during the measurement webcast, and we'll look at some modification-specific examples of establishing discount rates in a later slide. So having calculated the modified lease liability, the lessee then needs to work out the accounting entries, and these depend upon whether the modification decreases the scope of the lease.
Let's first look at the simpler of the two scenarios, a modification which does not decrease the scope of the existing lease. Essentially, this means that the right-of-use assets and lease liability that were on the balance sheet before the modification took place are still there. No element of the existing lease has been terminated. Instead, the lease has been added to or otherwise amended. This might be, for example, a change in consideration for the lease or an increase in scope without a commensurate increase in consideration. So, for example, adding some additional floor space to a property lease for which the additional consideration is less than would have been the case in a new standalone lease of the added space. In these cases, the lessee adjusts the lease liability to reflect the remeasured amount that we talked about on the previous slide. The other side of the accounting entry goes to the existing right-of-use asset, i.e. debit right-of-use asset, credit lease liability. In this case, the debit to the existing right-of-use asset represents a change in the cost of the right-of-use, or it represents an increase in the cost of the right-of-use if the modification increases the scope of the lease. This is similar to the way that at commencement of a new lease, the measurement of the lease liability is used as the starting point to measure the cost of the right-of-use asset. In the case of a modification, the measurement of the modified lease liability is used to measure the modified cost of the right-of-use asset. The other alternative is if there has been a decrease in scope of the existing lease. This will be the case if some element of the right-of-use asset and lease liability that were on the lessee's balance sheet immediately before the modification is terminated as a result of the modification. Examples include a reduction in lease term or a reduction in the lessee's rights of use, such as less floor space in a property lease. In these cases, there has effectively been a termination of some or all of the pre-modification lease. Therefore, the lessee needs to recognise this termination and any gain or loss on termination. To do this, the lessee must work out what element of the pre-modification right-of-use asset and lease liability have been terminated. There are some relevant examples in the IFRS 16 illustrative examples. For example, in the case of a reduction in square metres in a property lease, the lessee might work out the proportionate reduction in space and apply that to the pre-modification right-of-use asset and lease liability. The lessee then deducts the relevant amounts from both the right-of-use asset and lease liability, with any difference being recognised as a gain or loss on partial termination of the existing lease. Now, it's important to remember that quite often there will be both a decrease in scope of the existing lease and another element to the lease modification that is not part of the termination. For example, it could be the case that as well as terminating a portion of the existing lease, there has also been a change in consideration for the element of the lease that remains. When this happens, then after reflecting the partial termination, the lessee must also make a further adjustment to the lease liability to arrive at the modified lease liability that we talked about on slide 6. The other side of this adjustment reflects a change in the cost of the remaining right-of-use asset, similar to what we discussed on slide 7.
So to summarise, when a modification decreases the scope of an existing lease, the lessee first recognises that decrease in scope by reducing the pre-modification right-of-use asset and lease liability and recognising any gain or loss in P&L. The lessee then recognises any other element of the lease modification, such as a change in consideration for the remaining lease, by making corresponding adjustments to the right-of-use asset and lease liability.
Yes, that's right. And again, just to note that there are detailed examples on this in the IFRS 16 illustrative examples.
Now let's move on to looking at the implementation questions that we've heard to date. Modifications are most easily discussed by way of example. So what we'll do in this section is put some examples up on the slides and talk through the particular elements that have given rise to questions. So firstly, let's look at some questions we've heard that relate to the effective date of lease modifications. IFRS 16 defines this date as the date that both parties agree to a modification. So in practice, often the date that the modified contract is signed. Paragraph 45 of IFRS 16 is clear that in all cases, other than those accounted for as a separate new lease, the measurement of the modified lease liability takes place at the effective date of the modification. That includes, for example, establishing an appropriate discount rate. The reason IFRS 16 requires this to be done at the effective date of the modification is because it is the facts and circumstances at that date that the lessee and lessor would have had in mind when negotiating the modified contract. The questions in this area essentially relate to when a lessee recognises the modified lease liability and the associated modification to the right-of-use asset. There are 3 scenarios here, and we'll look at an example of each. First, a modification that decreases the scope of a lease. Second, a modification that increases the scope of the lease other than by increasing the lease term, so by adding the right to use one or more underlying assets. And third, a modification that increases the lease term. Let's look at some examples of each of these scenarios. So first, we have a modification that decreases the scope of a lease, but for which the effective date of the modification is before the decrease takes effect. So let's say you have a 10-year lease of 2 floors of a building. At the end of year 4, you agree to modify the lease so that for years 6 to 10 you lease only 1 floor. In other words, at the end of year 5, you will give back 1 floor to the lessor. The modified contract is signed at the end of year 4, but the second floor is not returned to the lessor until the end of year 5. Now in this case, the lessee recognises the lease modification on its balance sheet at the effective date of the modification, so at the end of year 4. This means that the lessee will reduce the lease liability and the right-of-use asset at the end of year 4, and it will also recognise any gain or loss arising on the partial termination of the original lease at the end of year 4. The questions that have arisen in this area are an understanding why the lessee accounts for the modification at the effective date of the modification. In our example, the effective date of the modification is a year before the second floor will be returned to the lessor. So why account for any gain or loss arising at the earlier date? Catherine, can you clarify?
Yes. So, as you said, in this case, both measurement and recognition of the modified lease occur at the effective date of the modification. That's because as soon as the modified contract is signed, both parties have contractually agreed that the lessee will pay less lease payments than under the original contract. Effectively, this means that from the effective date of the modification, all of the following have been reduced. First, the lessee's obligation to make lease payments. Second, the lessee's rights with respect to use of the underlying asset. And finally, the cost of the lessee's right of use.
Okay, that makes sense. I think, though, that the element that some might find difficult to understand is that the portion of the asset that will be given back to the lessor, so in our example, the second floor, is still in the possession of the lessee and under the lessee's control until it is returned to the lessor. Some have said that accounting for this reduced right of use at the effective date of the modification appears inconsistent with the general model that says a lessee recognises lease assets and liabilities at the commencement of the lease. That's the case even if the contract is signed by both parties at an earlier date. So can you share your thoughts on that?
Yes, so a couple of thoughts here. Thinking about the beginning of a new lease, it is of course correct that right of use assets and lease liabilities are not recognised by a lessee until the underlying asset has been made available for the lessee's use. However, it's important to remember that a lessee only ever recognises an asset that reflects its rights to use the underlying asset. It doesn't recognise the underlying asset itself. So say a lessee leases an asset with a fair value of $1 million for half of its useful life. It doesn't recognise the $1 million on its balance sheet because it doesn't have rights to use the asset for the whole of its useful life. Instead, it would recognise something less than $1 million because it has rights to use the asset for only half of its useful life. Even though the lessee receives the entire asset on day one of the lease, it never recognises that element that must be returned to the lessor at the end of the lease. This principle is exactly the same when talking about a modification that decreases the scope of the lease. As soon as both parties have contractually agreed that the underlying asset or part of the underlying asset will be returned to the lessor early, then the lessee's rights with respect to the underlying asset have reduced. Therefore, it is correct and consistent with the rest of the standard that the modification is recognised on the date of that contractual agreement. This reflects the reduction in the lessee's rights and corresponding obligations.
Okay, next let's look at a modification that increases the scope of the lease. An example fact pattern is on this slide. In this case again, we have a 10-year lease of 2 floors of a building with a modification agreed at the end of year 4. This time, however, the modification adds a 3rd floor to the lease for years 6 to 10. The modified contract is signed at the end of year 4, but the lessee gets access to the additional floor only at the end of year 5. Now, applying paragraph 45 of IFRS 16, the lessee again calculates the modified lease liability at the effective date of the lease modification, so at the end of year 4. That means, for example, that the lessee uses the relevant discount rates at that date. The difference in this example, however, is that the lessee recognises the modified lease liability and right of use asset on the balance sheet only when the additional floor is available for its use, so at the end of year 5. In other words, measuring these amounts occurs based on the negotiation that took place at the effective date of the modification, but recognition occurs at commencement, when the additional asset is available to the lessee. Catherine, any comments for those who have raised questions here?
Yes, just to explain a little, this recognition approach essentially reflects a difference between a decrease and an increase in scope. As I mentioned on the previous slide, with a decrease in scope, even though the lessee physically possesses a whole asset, if it gives up some of its rights with respect to using that asset, then the reduction in the right of use asset and lease liability needs to take place as soon as those rights are surrendered. With an increase in scope, it is only when the increased asset is delivered by the lessor that the increased right of use asset and lease liability are reflected. This is the same as initially recognising the right of use asset and lease liability at the beginning of a lease, only when the lessor has made the right of use asset available. So, to reiterate, and in answer to the question on the slide, in this case, the lessee recognises the additional third floor on its balance sheet when it is made available to the lessee, i.e. at the end of year 5.
Okay, so moving on then. The third example we'll look at covers a modification that increases the lease term. This time we have a 5-year lease of a property with a modification agreed at the end of year 4. That modification increases the lease term for a further 5 years, so to 10 years in total. Now the first question we've heard here is whether an increase in lease term satisfies the criteria to be accounted for as a separate new lease. And in short, no it doesn't. Referring back to the requirements that we discussed earlier in paragraph 44 of the standard, an increase in lease term does not add the right to use any new or additional underlying asset to the contract. The underlying asset is unchanged. Therefore, a lessee does not account for this modification as a separate new lease.
No, it's not accounted for as a separate new lease. So in terms of what is done here, the lessee first needs to identify the effective date of the modification, which again is at the end of year 4. Consistent with paragraph 45 of IFRS 16, the lessee therefore measures the modified lease liability at the end of year 4. The lessee then moves on to think about when the extended lease term should be recognised on the balance sheet. This is a good example because it really clarifies some of the principles that we've talked about on the last couple of slides. With an increase in lease term, as opposed to adding the right to use new underlying assets, then as soon as the modification is agreed, the lessee already has possession of the underlying assets over which it has agreed additional rights of use. And therefore, the lessee recognises those additional rights of use, along with the modified lease liability, on its balance sheet as soon as they have been agreed. So, in this case, the modification is both recognised and measured at the end of year 4.
So the next topic we've heard questions on is discount rate. IFRS 16 is clear that when calculating the modified lease liability, a lessee uses a modified discount rate. This would be either the rate implicit in the lease for the remainder of the lease term at the point of the modification, or if that's not readily determinable, then the lessee's incremental borrowing rate at the effective date of the modification. However, we've heard some questions relating to the illustrative examples in IFRS 16. In particular, some have noted that there are places in the modification examples where the original discount rate is used, in particular in illustrative example 18. This example relates to a modification that both increases and decreases the scope of a lease. So this is a detailed example, and the key facts are summarised on this slide. The lessee initially has a 10-year lease of 2,000 square metres of space, with annual lease payments of £100,000. Halfway through the lease, at the end of year 5, the lease is modified to add another 1,500 square metres of space to reduce the total lease term from 10 years to 8 years, and finally to increase the annual lease payments to £150,000. Now, this is a fairly complicated example, and a helpful starting point in these kinds of cases is to identify the different things going on within the modification so that each one can be thought about individually. First, there is a decrease in scope. So this relates to the fact that originally the lease was for 10 years and the modification reduces it to 8 years. So whatever else is going on, the lessee needs to recognise a partial termination relating to that reduction in lease term. Second, and separate from the reduction in lease term, there has been an increase in the size of the remaining right-of-use asset. Originally, the lessee had rights over 2,000 square metres of space, but after the modification, it has an additional 1,500 square metres. What a lessee essentially has to do here is think about those two elements of the modification separately.
So first, thinking about the decrease in scope. Now, applying the modification requirements in IFRS 16, all the lessee is doing here is recognising a partial termination of the original lease. In other words, it needs to remove from its balance sheet that element of the right-of-use asset and lease liability that has been disposed of. For the right-of-use asset, at the point of the modification, the lessee is giving up 2 years of the remaining 5-year term of the original lease. Therefore, the example illustrates that the right-of-use asset disposed of is 2/5 of the right-of-use asset that appears on the balance sheet immediately before the modification. For the lease liability, the lessee must also work out how much of the lease liability on the balance sheet immediately before the modification relates to the final 2 years of the original lease. At commencement of the lease liability was calculated using the original discount rate, and therefore it is that same original discount rate that needs to be used in determining what to remove from the balance sheet. That's why the example talks about using the original discount rate. Having worked out the amount of the right-of-use asset and lease liability representing rights and obligations that have been terminated, the lessee then recognises any difference between the two as a gain or loss on termination in P&L. After recognising the partial termination, the lessee then looks at the modified lease liability, i.e. the present value of the future lease payments under the modified lease. This modified lease liability effectively includes the increase in scope relating to the new space that the lessee will have the right to use. The lessee calculates the lease liability and corresponding adjustment to the right-of-use assets using the modified rates, i.e. the rate that applies at the effective date of the modification.
So to summarise then, the original discount rate is used only when working out what needs to come off the balance sheet in a partial termination. The modified discount rate is used when measuring any other modifications, such as changes in consideration or increases in scope.
Yes, that's exactly it. You can also see on the slide the relevant paragraph numbers of IFRS 16 that relate to these scenarios.
Great. So we've talked through a number of examples that highlight the various implementation questions that we've been hearing. So it's probably worth summarising the key takeaways from those examples.
Sure, and these are summarised on this slide. First, in all cases for which a modification is not accounted for as a separate new lease, a lessee measures the modified lease liability at the effective date of the modification, i.e. the date that both parties agree to the modification. This is the case even if there is then a delay before any practical modification to the right of use takes place. If there is such a delay, the lessee needs to think about whether it has already got access to the modified right of use asset. If it has, then it also recognises the modification on its balance sheet from the effective date of the modification. If the modified right of use asset is not available to the lessee at the effective date of the modification, then, consistent with recognition at commencement of a lease, the lessee recognises the modification when the asset is available for its use. Second, we've seen an example of a modification with multiple elements. In these kinds of scenarios, it is helpful to identify each separate element of the modification and deal with it separately. So, for example, calculate the gain or loss on a decrease in scope relating to a reduced lease term, and then work out the effect of an increased scope of the right of use asset. Illustrative example 18 of IFRS 16 covers this in detail. Third, remember that when calculating the effects of a lease modification, it's generally necessary to use the modified discount rate, i.e. the discount rate at the effective date of the modification. The exception to this is if there is a partial termination, i.e. some of the right of use assets and lease liability that were originally on the balance sheet are being removed. In this case, a lessee uses the original discount rate when working out that element of the pre-modification lease liability that needs to be removed from the balance sheet. Finally, just to highlight that there are 5 detailed illustrative examples in IFRS 16 that cover all of the different modification scenarios. Separate new leases, increases in scope, decreases in scope, multiple element modifications, and changes in consideration. These examples are likely to be useful in applying the IFRS 16 requirements on lease modifications.
Thank you. So this final slide notes a couple of links to further information that can be found on our website. The second link, which is to the Leases implementation page, summarises all of the work the board is doing to support implementation. Within that, there's some information about the rest of this webcast series, links to previous webcasts, and the list of upcoming webcasts can be found by following this link. We thank you for listening to our webcast and hope that it was helpful.